Okay, I'm going to try for a third time to record this. For whatever reason, somehow or another, the audio settings for my recording software got changed, and the previous two versions didn't record, which I found out only after doing all the recording and rendering them as MP4s. This time, I'm pretty sure it's working. So, question number 7, a bargain purchase. On January 1st, 16, Big acquired 60% of Little Company for $240,000. The fair value of the non-controlling interest on that date was $160. Little had the following trial balance on that date. Little also had property, plant, and equipment net undervalued by $50,000 with a 10-year life. They reported earnings of $100,000 for the current year and paid no dividends. Record all entries by Big to account for their investment in 2016, as well as the elimination entries for the 2016 consolidation. Now, in reality, of course, there wouldn't be a big flashing sign that says, hey, this is a bargain purchase. Instead, you would discover that when doing the differential analysis. So let's go ahead and do that. And as always, we'll take our cost of the investment, $240, add the fair value of the non-controlling interest to get up to $400,000. We subtract out the book value. Total book value is $370. Our share $222 to get a differential of $30,000. Our share $18,000. We subtract out the undervalued property, plant, and equipment, our share $30,000, and we end up with a negative remainder. Now, in other cases, the remainder is positive. That's that unexplained premium that we paid, which we call goodwill. In this case, we end up with a negative remainder. This is going to be our bargain purchase. And again, our share, $12,000, that's our $12,000 bargain purchase. So how do we go about recording this? Well, think of the total value of the subsidiary. The book value of the subsidiary is $370. All of their assets and liabilities have a fair value equal to book value except for property, plant, and equipment, which is worth another $50,000. So the total value of the subsidiary as a business entity is $420,000. Our share of that, 60%, is $252. So we're going to go ahead and record our investment at our share of the value of the business, $252,000, rather than the $240,000 we paid. The difference is going to be that gain on bargain purchase. So this is one of the few, if not the only place where you can record a gain by virtue of buying something. Normally gains are recorded when you sell something, when the earnings process is complete. So this is going to come in real handy when we do our consolidation, because now our investment in Little account equals 60% of the subsidiary's book value plus differentials. That's going to come in real handy in making our S entry balance. The remainder of this is just like any other consolidation problem. We record our investment income. Little reports earnings of $100,000. Our share is $60,000. We've also got the differential amortization. Again, there's a $50,000 property, plant, equipment differential being amortized over 10 years at $5,000 per year. That's going to reduce Little's reported earnings, or that's going to reduce earnings by $5,000. Our share of that, $3,000, so we reduce our investment income. Now we jump over to our elimination entries, and again, this whole thing is exactly like any other set of elimination entries that we've ever done. The only place where this bargain purchase is evidenced is in the initial acquisition. So we eliminate our beginning of year equity accounts, the same as we've always done. We record that differential asset, the same as we've always done. We take that total of $420,000 and we split it 60-40 between the investment in Little and the non-controlling interest. And again, here's where that nice little balancing comes in. Our credit to the investment in Little is equal to what we recorded as our acquisition cost. A for amortization, the usual fashion. I for investment income. How to get the $57,000 of investment income? Well, look at the equity method entries. We recorded $60,000 of investment income. We took away $3,000 because of the amortization. So we've got $57,000 of investment income, which has to be eliminated. And then finally, the income to the non-controlling interest in the usual fashion. They get their share, 40%, of the subsidiary's reported earnings of $100,000 minus that $5,000 adjustment to depreciation expense. Okay, so hopefully this time worked. Third time's the charm, as they say. And as a bonus to you, this was a lot shorter than when I first typed it up and narrated as I typed.